Hi, my name is Jordan Wilson. Today we're going to start looking at what I think are probably the best investment products for your portfolio. In our previous episode, we looked at investment funds versus using individual assets to build a portfolio. And I think the key takeaways there were that for most investors, it's not really cost effective to build a portfolio out of individual stocks and bonds. Also, you need this critical mass to create a diversified portfolio. Plus, there's the opportunity cost if you're not an investment professional to spend your free time analyzing 50 or 60 different investments in your portfolio, as well as potential investments that you might want to add. And that's why I think that at least until you have a critical mass and a well-diversified portfolio foundation, then probably investment funds are the better way to go. Today we're going to look at a little bit about mutual funds, and then we'll get into the advantages and potential disadvantages of using mutual funds. So why is it important to look at mutual funds? Well, there are a lot of them. If we look at the United States, in 1959, there were only about $21 billion invested in investment funds. And by that, I include open-end mutual funds, closed-end funds, and exchange-traded funds. And about 35%, 1/3 of investors in mutual funds did so for retirement. We fast forward to 2019, and in the US now, $26 trillion is held in investment funds. And that equates to 120% of the US gross domestic product. So very large. Currently, the breakdown is significantly higher in open-end mutual funds, about 21.3 trillion of the 26 trillion in the US. And there's only about 4.4 trillion in ETFs and 0.3 trillion in closed-end funds. And that's why, as I mentioned in the last episode, we probably won't spend any time discussing closed-end funds because you probably won't come across them unless you happen to be looking for them. We also see that mutual funds are now owned in large part for retirement objectives. 73% of US mutual fund holders do so for retirement. And I think part of that is due to the shift from defined benefit pension plans into defined contribution plans. Because what you tend to see there is that the defined contribution plan holders generally have options of 4, 5, or 6 different mutual funds in which they can invest for their retirement through the company. The same holds true on mutual funds on a global basis. In 2010, globally, there was about 29 trillion US dollars invested in mutual funds, and that equated to about 86,000 funds globally. 9 years later, we're up to 55 trillion and over 122,000 different funds. So if you're just investing in general, there are so many funds out there in which to place your money. And that has its benefits, as we'll see a little bit later. The distribution of those global funds, about 45% is equity, 21% fixed income, Another 21% mixed, probably mostly balanced funds. And about 13% of the cash is invested literally in cash or money market investments. In Canada, much smaller investment community. Canadians in 2019 have 1.4 trillion invested in 3,500 different funds. So even though it's much smaller in Canada, that's still a heck of a lot of funds to possibly invest in. Now we're going to focus on the open-ended mutual funds, not the closed-end. And what we see, just as a reminder, is that you purchase and redeem your units, or sometimes called shares, directly through the fund company. If you want to buy a Fidelity mutual fund, you buy and sell through Fidelity. If you want to buy through RBC, an RBC fund, or a Scotia fund, then you go to the respective fund companies to make your purchases. The price is normally just the net asset value. There tends not to be significant premiums or discounts. You tend to see more premium and discounts on the pricing in a closed-end fund. The bigger funds, they all tend to buy and sell on a daily basis, which gives you more or less liquidity. I mean, if the markets all crash during the day, you may be out of luck. But again, for larger funds, your liquidity isn't bad. Smaller funds, hedge funds, liquidity may be more of a problem. So just watch the frequency in which the fund company will buy or sell units. And the other point I made on open-ended funds is open-end funds may close. That does not make them closed-end funds. It just means that they're cut off from new investors. And the reason for that tends to be that they've become too big, too many assets under instrument to allow them to effectively implement their investment strategies. If they're investing in small cap stocks and suddenly they're a $2 billion fund, that might make it problematic to invest all the assets. Investment styles. Well, the big one tends to be cash, fixed income, equities. Those are sort of the three major asset classes. And they're usually broken down into subclasses. Probably every combination you could seek. So again, depending on whatever you want to invest in, there's probably a fund available to meet your needs. Assessing performance is important because that's how funds tend to attract investors. Why would I go to an underperforming fund when there's better funds out there? And if we're assessing funds, there's a variety of rating agencies. Morningstar tends to be a big one. And Morningstar, they have a star ranking system. And basically, they put things on a risk-return adjusted basis over a variety of time periods, say 1, 3, 5, 10 years, life of fund. And then they compare with the other funds in the same asset class, subclass. And a fund that falls, say, within a top 10% of all funds, that merits a 5-star rating. If it sits in the next 22.5%, it earns a 4-star. All the way down to if it sits in the bottom 10% of its asset class, investment class, category, it's only a 1-star. So again, why would I want to invest in a 1-star fund that's in the bottom 10% of all the funds in that class? So it's important to just look at the different ratings and factor them into your calculations. You also see screening tools, which is a bit similar to ratings, where you use your own criteria to determine investments. So if I'm using the Morningstar, maybe I want to see all Canadian equity funds that have been a minimum of 4 stars over the last 5 years. So that gives me an idea of a fund that's been around for a while, it's performed in the higher echelons, and it's to that specific class. You can also look for screening things that have minimum dividend yields. So if I'm looking for stocks that have nice dividend yields, maybe I'll put in a screening tool looking for a stock that has minimum of a 4% dividend. So there's a variety of tools out there that you can use, and you can filter in a multitude of ways. The problem, though, with relying on ratings is that ratings are going to be based on history, last 3, 5, 10 years. And as we discussed with standard deviation, yeah, there's some historic, but what if the circumstances change? What if the people that run that 5-star fund suddenly quit to go run a different fund with a different fund company? What is your assurance that that past history is going to continue on into the future? So that's an issue to have. Also, I think people, if you fixate on short-term performance, that can be problematic, because I might take on more risk in my portfolio relative to my peer group in order to generate maybe higher returns. But over time, maybe that risk will catch up to me. So you want to try to look for, 5 or 10 or 15-year performance versus, year to date, they're outshining everybody and they're sort of 5-star year to date, but over 10 years, they're only 2-star. So there can be short-term fluctuations, sometimes noise, sometimes a change in tactics that aren't in line with the risk-return profile for that investment category. So again, just things to look at. Just want to go through a few different mutual fund categories that are out there. This isn't anything too special. On the one end, the low risk, low return money market, cash instruments. And that's going to invest in short-term debt, less than 1 year in maturity. Might be some foreign currency, so you could invest in a US dollar or a euro money market fund. Slightly higher return, slightly more risk would be fixed income. That's government, corporate debt, some preferred shares. Often that's broken into subcategories based on the quality of the issuer. Am I a AAA rated company or government? Or am I junk bond status, or also called high yield? And the lower the credit quality of an issuer, the higher the interest that they'll have to offer to compensate for that additional risk. Term to maturity is another category. Short term, medium term, and depending on where you are, the medium term could differ, but let's say, sort of in that 3 to 10 or 15-year category. And then long term, maybe that's 20 to 30 years. Geography can play a part. Maybe I'm investing in Venezuelan bonds. Maybe I'm investing in German bonds. And because of that, maybe I have exposure to foreign currency. But the other thing you can find is you can invest in, say, a provincial government bond in Canada and for whatever reason, they have issued it in, say, US dollars. So you can invest locally and get exposure to foreign currency if you so desire. Equities, largest asset class, most subclasses, also the highest risk, highest return of the three asset classes on an average basis. People invest in equities for the capital appreciation. That's the usual objective. Some might be looking for income focus, and there's things called equity income funds that try to generate strong dividends. There's also, when we get into ETFs, there's funds that are, for example, dividend aristocrats that have certain filters. We talked screening just a second ago. So they screen all the dividend producers for certain criteria. Usually that involves increasing dividends over the last 5 years, growing earnings per share, consistency in payout. So if you're part of this aristocrat, there's a good chance that you'll continue getting a solid dividend over time. And companies like to be in these screenings, so they're not keen on reducing their dividend or doing things that'll get them kicked out of the benchmark. Equities might also involve foreign currencies. So if I'm in a mutual fund that's invested in Europe with the euro, maybe I have exposure to the euro as a foreign currency. But what you'll also find is that with many mutual funds, they tend to be offered in a hedged and unhedged version. So if I want to be, as a Canadian investor, investing in the S&P 500 in the US, I can go out and buy a US dollar version, or I can buy a Canadian dollar hedged version. And there's valid reasons for hedging or non-hedging. And we'll get into the hedging versus non-debate down the road. Equity subclasses. The key ones tend to be by capitalization, market cap. You might have the Apple, the Microsoft, the Amazons, the Google at the mega size. And then you got large, mid, small, and the nanos. Nanos would be, your mom and pop shop with minimum market capitalization. Hard for the bigger mutual funds to invest in just because of a size issue. You'll see subclasses based on geography. A US-centric mutual fund. Europe, Australasia, Far East. Something that focuses on Japan. You'll also see funds by market. And by that I mean a developed market, Germany, the United States, versus an emergent market, so the emerging markets. And that might be Poland, Colombia. Or on the least developed, you have, say, frontier, which might be Kenya as an example. Style is another way to delineate equities. The growth stocks, that's the stocks that you're buying for the capital gain potential. The companies will reinvest their profits and cash flow back into research and development, acquisitions, marketing, to grow the company, which hopefully will be reflected in a growing share price. Versus a value company, which is mature. It doesn't have a lot of growth areas. So it tends to use its profits and its excess cash flow to return in dividends to the shareholders. And with those dividends, then the idea is the shareholder takes that cash and invests in another opportunity that does provide better growth potential. Blend would be a mix of growth and value. Low volatility or minimum volatility, that's sort of come around in the last few years, and they're looking at stocks that are less volatile, have lower standard deviations than the market or the market benchmark as a whole. We also see subclasses by sector: energy, materials, technology, utilities, consumer staples, consumer discretionary. So you can invest if you think that energy sector is the way to be. You can invest in a subclass there. If you think the tech sector is on a roll, same there. So again, regardless of how you want to invest or what sort of things you want to invest in, there's going to be a fund out there that meets your needs. Another category is the balanced funds. And by balance, they're trying to find a balance between security, which would be cash, income, whether that be dividend income or interest income, that's predominantly your fixed income, and growth, which mostly is your equities. The asset mix will be stated in the fund's prospectus, which discloses its investment objectives, its strategies, its policies. And that might be the balanced fund is 60% equities, 30% fixed income, 10% cash. But you'll also see it usually delineated further down into subclasses. If that 60% equities is in a global balanced fund, maybe it'll be further broken into 60%. Of that 60%, 50% is going to be based in US equities. 30% will be in EAFEs. And 20% will be in emerging markets and rest of world. So the 60% equities is further broken down. And again, that should all be disclosed. The two caveats I just want to mention here are asset allocation funds being one. And a balanced fund, yes, it is an asset allocation fund. As we just said, 60, 30, 10 is the allocation. But you often see asset allocation specifically referring to slightly different vehicles. So I might have an asset allocation that allows me to invest 30 to 50% in equities, or 60 to 80% in equities. Often there's a little bit more flexibility as to what the investment managers can do. So just if you see a balanced fund or you see an asset allocation fund, dig just a little bit deeper to see what you're actually getting. And the same holds true with target date funds, and they've tended to be quite popular in the last 5-10 years. A target date fund is simply a balanced fund that, as its target date approaches, it starts to shift its asset allocation. For example, if I have a 2050 target date, and usually that's in coordination with when I intend to retire, it'll probably be about an 80% equity, 20% fixed income fund until about 5 to 10 years before that retirement date, that maturity date, in this case 2050. And then it'll start to move the asset mix in that last decade by year. So it'll be, instead of 80-20, it'll be 70-30, 65-35, 60-40, etc., etc. And the idea is that you're shifting from higher risk, higher volatility assets into more stable assets as the target date, the maturity approaches. The difficulty with that is often you're paying fairly expensive fees for this. And if you look at a lot of them, as I say, they don't actually start reallocating until 5 to 10 years before the maturity date. So if you're buying a 40-year fund, essentially you're paying a lot more for the first 30 years when it's just strictly a 80-20 or whatever asset allocation. And the final category I want to just discuss briefly is the specialty side of the funds. And again, variety of asset choices. You might find real estate funds, precious metal funds, collectibles, fine art, that sort of stuff. And another hot one these days is the ESG, the environmental, social, governance funds. And that's where maybe I don't want to invest in environmentally unfriendly stocks such as mining companies or oil pipelines or things like that. So these funds use screening tools and filters of their own to eliminate things that they consider ESG unfriendly. And again, there's a wide definitional base as to what is an E or what is an S or what is a G. So you'll have to look at each prospectus to see what they discard from their potential investment pools. Now, I think the other comment I just want to make while we're on this, and I'll get back to it no doubt in the future, is that mutual funds are there to market. They're there to attract investors. And yeah, okay, a lot of it has to do with investor desires, but they're always looking for new shiny baubles to attract people. Target date funds. Whoa, isn't it great? You plan to retire at 2050. Let's create a fund that specifically matures in 2050 for you. Okay, maybe that makes sense, but as we saw with our investor profiles, not everyone has the same objectives, and just because you're retiring in 2050, that doesn't necessarily mean that you want to have the same asset allocations as the target date does. The environment, social, governance, they're hot topics, so let's create funds that we can market based on people's desires or feelings. And maybe those are good investments, maybe they're not, but they sound good. And maybe we can charge a premium for those. And the same was true if you look back, say 5 or 10 years ago. Factor investing was the shiny bauble. We'll put in these fancy screening tools, and that's how we'll pick our investments and charge you a nice premium for that. But again, we all factor invest, we all screen regardless. It's just a new label that you slap on a mutual fund so you can justify maybe a premium fee, or at least to attract new investors. That's all I want to discuss today on mutual funds. It was just a quick overview of what they are and the different investment vehicles that are on offer. Huge assets under management, extremely large offerings, so that pretty much regardless of what you want to invest in, what should fit into your target asset allocation, you should be able to find a decently diversified fund at a reasonable annual price tag. Next time up, we'll look at some of the perceived advantages of investing in open-end mutual funds, as well as some of the perceived or actual disadvantages of mutual funds. And then we'll move on to exchange-traded funds, which are similar, but a little bit different. Thanks again for your time today. Have yourself a good one.